Thank you very much for joining me in this video. You know, it's been an interesting ride in real estate over the past few years. We can go all the way back to 2017, and a robust year it was in 2017 with prices going up and activity in the marketplace. I remember one of the salespeople saying to me, you know, we're never going to see a year like 2017 ever again. Well, along came COVID in 2020. And I remember listening to some podcasts and some interviews where people were telling realtors how to prepare for this crisis that we were going through, this pandemic. And they were saying, you know, make arrangements with your creditors that you can pay over time, because they were expecting a huge slump. Nobody saw it coming, but we saw a boom like we've never seen during the COVID era. We saw prices go up. In fact, in January of 2022, in Niagara, we saw the average price go up $100,000 in 1 month. Well, then COVID came to an end, and along with the end of COVID, we saw a price slide. And we began to lose the gain that we'd made the previous few months, and in fact, the previous year. When the dust settled, we saw average price had dropped by 25%. Then this year it started coming back, and we gained back 10% of that. We're still down 15, 16% from the peak. But it's been turbulent times, for sure. And the economy in general, the same way. I'm not actually involved in the stock market, but I know people who are, and they tell me they made a lot of money here, they lost a lot of money there. They lose a lot of sleep watching the stock market. And of course, then you can talk about cryptocurrency and the amazing amount of money people made in cryptocurrency if they bought at the right time, and the amazing amount of money they lost when they hung on too long and then should have sold. And then we're watching interest rates, and we saw interest rates under 2% for mortgages. We never seen it like that in years and years and years. And then we've seen the Bank of Canada and trying to battle against inflation, crank interest rates up and up and up till we're hovering around 6%. And I wouldn't be surprised we'll end up 7.5%. The overall economy is shaky. People, I've seen them move their assets to third world countries because they're afraid that the Canadian government's going to seize all their assets because of the problem that we're all in and we're all facing in the economy. And the question I say to you as an investor, should you be worried? Should you be worried with all this turmoil, all the economic uncertainty, all the prices up and prices down and interest rates down and interest rates up, all that? And I'm telling you, absolutely not. If you go back to the Money Machine seminar and the simple plan was 3 steps. Buy one property a year for 10 years, never amortize over more than 15 years, and the third one I want to stress is never sell. And so we're in a totally different camp than the speculator. You know, the speculator, timing is everything. He's got to get in at the right time, and he's got to get out at the right time. He's relying on changes in the market to make him money. It's like a day trader, and that's what he's got to do. But you know, for those of us who are true investors, it's not so. We got to find a property that we like and buy it. We got to find a tenant that we like and rent it. And then we've got to keep it and gradually pay it off with the revenue coming in from the tenant until it's paid off, and then enjoy the passive income on in retirement. So let's look at some of the what ifs. You can say, well, what if it goes down in value? Well, and it has. But you know what? It's nice to do a net worth statement at the end of every year, and I encourage people to do that. You do your net worth statement. It's nice to see that it's grown, our value, our net worth has grown. But sometimes when you go through what we went through post-COVID, you might see your net worth shrink. But you know, although it's nice, it doesn't really impact on us. The mortgage is in place, the tenant is in place, the cash flow is servicing the debt, and the property is being paid off. So it doesn't really change anything. Well, you say, well, if I timed it better, if I bought it when it was really at the bottom end and then had it now, I wouldn't have lost in the downturn, and I would have a higher net worth. Well, that may be so, but you know what? In the long haul, it really doesn't matter. I remember back in the late 80s, I bought 3 semis, and I paid $66,000 each for the 3 semis, and I overpaid a little bit. I should have paid $64,500 probably instead of $66,000. But I still own them. They're still rented out. And you know, looking back, does it really matter whether I paid $64,500 or $66,000 now that they're worth $500,000? Doesn't matter at all. I bought a property really nice property right at the peak of the market in 1990, just in the very early part of 1990 before the market started to turn down. I lost 15%, as we are sitting today, of that property value in the next year, year and a half. But now, it's many years later, the property's worth 4 to 5 times what I paid for it, and it really doesn't matter. Sure, it would have been nice to have bought it maybe a year later and paid maybe $15,000 less for it or $20,000 less for it. But overall, in time, it really doesn't matter. It doesn't impact. We think about the downturn in the U.S. in 2008. We hear about people losing their properties and banks with dishes on the president's desk where all the keys would be thrown in as people surrendering their properties. But you know, the person who bought to live in it had a mortgage, the mortgage was in place, they paid the mortgage, they came home and enjoyed their house, didn't impact on them. And the investor who bought to rent out and hold didn't impact on them. It impacted the speculator who was buying with a long closing with the plan of flipping and making a profit. When the market hit a brick wall and there was no profit to be had, they were hanging out on a limb. But it wasn't the case for the true investor, and it won't be the case for you either. So I firmly believe there's never, ever a bad time to buy a piece of real estate. It's a case of finding the right piece of real estate, not the needle in the haystack amazing deal, but the one that talks to you, the one that just seems like the right property. When it's there, buy it. Don't worry about whether you could get it cheaper 6 months from now or whether you could have got it cheaper 6 months earlier. If it's there and you can rent it and you can look after it, you can be a landlord from it, and you can pay off the mortgage, do it. And then while the speculator tosses and turns, whether he's a day trader or whether he's in real estate, you can sleep comfortably at night because you're following the simple plan, everything's in place, and things are going to move exactly according to plan. Thank you very much for taking the time to watch this video. I'll talk to you again next week.